A stock with a 10% dividend yield sounds like a dream until you find out why it could be your worst nightmare. Imagine getting money deposited into your account every year just for owning a stock. Sounds like the perfect passive income, right? The magic word is dividend yield. But hold on, not every high yield is good news. Today, we'll break down what dividend yield really means, how to calculate it, the traps to avoid, and I show you how betting against the market. Dividend yield is a simple but powerful metric. It tells you how much dividend you receive compared to the current stock price. The formula is straightforward. Dividend per share divided by stock price times 100 equals dividend yield in percent. Example, a stock costs $100 and pays $2 in dividends. 2 divided by 100 times 100 equals 2% dividend yield. Sounds easy, but remember, both the stock price and the dividend can change at any time. I'll explain to you what information you should really extract from the dividend yield and how you might even bet against the market. Leave me a like if you are interested in such videos. A dividend is a payout from a company to its shareholders, usually from the previous year's profits. But it can also be paid even if the company had a loss. In that case, it comes from the company's assets. Important. When the dividend is paid, the stock price drops by the amount of the dividend. This is called the dividend drop. Example, stock at $150, dividend $5, next day it's $145 if nothing else changes. Pros and cons of dividends. Pros, regular income, partial return of your invested capital, potential long-term downside protection. And what are the cons? Money leaves the company. Stock price takes a hit. Dividends are never guaranteed. Let's take a fictional but realistic case. The stock of Energy Plus Inc. is trading at $20 and pays a $2 annual dividend. That's 2 divided by 20 times 100 equals 10% dividend yield. Sounds amazing, but why is it so high? Scenario 1. The company is healthy, stable, and has low growth, like many utilities. Scenario 2. The stock price has crashed due to problems, and the dividend will soon be cut. If the stock used to trade at $40 and dropped to $20, that's a red flag. The high yield is often just a side effect of the price drop. If you don't want to bet on single stocks, dividend ETFs might be the way to go. They bundle many dividend-paying companies and pay out regularly. Advantage: broader diversification, less risk from a single company failing. Downside: overall market risk still applies. Dividend yield is an interesting indicator, but it's not a free pass to a great investment. A high yield can be a quality sign or a warning. My tips: always check why the yield is high. Analyze the business model and future prospects. Don't just look at the number, see the full picture. For beginners, consider dividend ETFs as a base. If you're a professional, look for stocks that are popular due to their high dividend yields. Check if the yields are high only because of falling prices. Then, you might be able to bet against the market and on falling prices here. But beware, trading carries risks. Always protect yourself with stop-loss orders in case the trade goes wrong. If you found this video helpful, hit that like button, subscribe, and tell me in the comments which companies have a high dividend yield and are still not good investments.